Have you ever wondered where money comes from and who creates it? Is it as simple as ink and paper, or is there more to the process? Could it be that banks or even entire countries are behind it all? Today we dive into the fascinating world of money creation. Money creation is a complex process that begins with a simple concept: lending. You might be wondering how lending leads to money creation. The answer lies in the role banks play in our economy. Banks are not just safe houses for our hard-earned cash. They are active participants in the economic cycle, and a significant part of their role involves lending money. But where does this money come from? It's not just the deposits they've gathered. In fact, when banks lend money, they essentially create new money. This might sound a bit like magic, but it's grounded in a system known as the fractional reserve banking system. In this system, banks are required to hold a certain fraction of their total deposits as reserves. The rest can be lent out. Let's break it down. Imagine you deposit $100 in your bank. The bank sets aside, say, 10% as reserves, which is $10 in our case. The remaining $90 can be lent out to other customers. Now here's the interesting part. That $90, once deposited by the borrower into their account, becomes part of the bank's deposits. And guess what? The bank can then lend out a fraction of this deposit again, creating even more money. This cycle continues, with each iteration creating new money in the system. It's like a ripple effect, where one action triggers a chain of events leading to an overall increase in the money supply. This process of money creation is vitally important. It ensures there's enough money flowing in the economy, facilitating transactions and promoting economic growth. And it's all tightly regulated by central banks to prevent any misuse and maintain financial stability. So when you borrow money, you're not just getting a loan, you're participating in the creation of new money. Central banks play a pivotal role in controlling the money supply. They are like the conductors of a vast economic orchestra, leading the melody of the market with their powerful tools. One of these tools is the ability to influence the amount of money in circulation, and they do this primarily through setting interest rates and reserve requirements. Let's break that down. When a central bank lowers interest rates, it becomes cheaper to borrow money. This encourages banks and individuals to take out loans, effectively increasing the amount of money in circulation. Conversely, when a central bank raises interest rates, borrowing becomes more expensive, which can deter lending and thus decrease the money supply. Now, what about reserve requirements? Well, these are regulations that dictate the minimum amount of money that banks must hold in reserve. By adjusting these requirements, central banks can control how much money banks are able to lend. A lower reserve requirement means banks can lend more, increasing the money supply, and a higher requirement means they can lend less, decreasing the money supply. But there's another tool in the central bank's toolkit, one that might sound like something out of a science fiction novel: quantitative easing, or QE. This is when a central bank creates new money, yes, literally creates it out of thin air, and uses it to buy financial assets like government bonds. By doing this, the central bank injects money directly into the economy, which can help to stimulate economic activity during times of financial crisis or recession. So, as you can see, central banks have a pretty big job. They're the guardians of our economies, using their powers to keep things balanced and stable. They adjust the knobs and dials of interest rates and reserve requirements, and when necessary, they can even turn on the money printer with quantitative easing. Central banks have the power to control the money supply, which influences everything from inflation to the strength of your country's currency. They are the unseen force that shapes our economic world, and understanding their role is key to understanding the complex symphony of modern finance. In today's digital age, the majority of money isn't physical. It's a concept that might be hard to grasp at first, but it's the reality we live in. While we often think of money as coins and bills, these physical forms of cash are only the tip of the iceberg. Underneath, in the vast ocean of our economy, most money exists digitally. It's in the form of numbers in bank accounts, shifting from one account to another with every card swipe, every online purchase, every electronic transfer. This is the money created when banks make loans, extending credit based on a fraction of their deposits. And this digital landscape is ever evolving. We're seeing an increasing prevalence of digital currencies like Bitcoin and Ethereum. These cryptocurrencies operate on technology called blockchain, a decentralized system that allows for secure peer-to-peer transactions. As these digital currencies gain traction, they have the potential to impact the way money is created. They could shift the power from central banks to the people, democratizing money creation. But even as we navigate this digital revolution, it's important to remember that the fundamental principles of money remain the same. Money, whether physical or digital, is a medium of exchange, a unit of account, and a store of value. It's a social contract, an agreement we all buy into. The digital revolution has transformed the way money is created and used, but the fundamental principles remain the same. To recap, money creation is a complex yet fascinating process. It is the lifeblood of any economy and is instrumental in ensuring that trade and transactions happen smoothly. Let's take a few moments to revisit the key points we've discussed. In essence, money creation is the process by which new money enters an economy. While it might seem like a simple act of printing more banknotes, it is in fact a much more intricate process that involves a variety of economic actors, but primarily banks and the central bank. Banks in their day-to-day operations are key players in money creation. Every time a bank grants a loan, new money is created. This is because in modern economies, money is not just physical cash, but also the digital numbers in bank accounts. When a bank lends out money, it doesn't take it from somewhere else. It simply adds the loan amount to the borrower's account, creating new money. Then we have central banks, the apex monetary authorities. They set the rules of the game and are the sole entities that can issue physical currency. Central banks also influence money creation indirectly through setting interest rates and reserve requirements for commercial banks. By doing so, they can control how much money is created by the banking system. And this brings us to the distinction between physical cash and digital money. Physical cash, the banknotes and coins we use, represents only a small fraction of the total money in an economy. The majority of money exists as digital numbers, in the form of deposits in bank accounts. This digital form of money is much more flexible and can be created or destroyed through the lending and repayment activities of banks. A key takeaway here is that money is not just a physical object, but a concept, a representation of value that is largely digital in today's world. And its creation is a dynamic process constantly influenced by the actions of banks, central banks, and even us as we engage in borrowing and repaying loans. Understanding money creation helps us understand the economy better. So next time you get a loan or make a deposit, remember you're part of this grand process.